Hi, I am Teena Jain Kaushal and you are watching Business Today. Joining me today is Rahul Singh, Chief Investment Officer, Equities of Tata Mutual Fund, to give us an outlook for the equities market. He will also tell us what themes and strategies are likely to play out going forward. Hello, Mr. Singh. Please tell us how is the stock market as a whole looking to you at this point of time?
Yeah, hi. I think the stock markets are a reflection of the economy and the way the economy is shaping up in terms of the various parts of the economy now doing well, which were not doing well, which is essentially the investment cycle uh, part of the economy, which was earlier lagging. And that has now started performing, whether you look at the government capex or private capex or even the real estate sector. And I think that is something which is getting reflected in the markets and the buoyancy in the markets. We are seeing that the profit forecasts which we had for this year and the next year are sustaining despite certain ups and downs, certain sectors not doing well, but the other sectors making up for it. So, all in all, there is a lot of resiliency to the economic growth as well as the profit growth forecast for the next 18 to 24 months. There are obviously risks in terms of crude prices and geopolitical risks, but at least as far as the internal fundamentals are concerned and the way India is positioned, it is quite a constructive view which we have on equities, and we have to watch the valuations, but from a fundamental perspective, the view is reasonably constructive.
That's interesting, but according to you, what is a big call in the market currently?
Well, I think, as I mentioned, the biggest change which has happened in the market or in the economy is towards the investment cycle revival. And remember that investment part of the GDP is almost 30%. So once that starts delivering even 7-8% growth from low single digit growth, then the overall GDP growth gets lifted, and ultimately that's good for consumption, that's good for inflation, and so on. I think the biggest call is that the economy is in a virtuous cycle where investment cycle will lead to more growth. More growth will lead to more tax revenues and therefore more ability for the government to invest in infrastructure and therefore promote more and more capex cycle by the industry, and it's a virtuous cycle. So I think that that's the big call, if you really ask me. And obviously, a lot of sectors benefit from that, and the rest is all kind of flows from that.
Also, there is a lot of hype around mid and small cap stocks right now. So, how do you see it playing out?
So mid and small caps, obviously, given that these sectors which are doing well today are very different from the sectors which did well over, say, 2010 to 2021. It means that there are more opportunities which are emerging in the small and mid caps from a fundamental perspective. If you look at the valuation for small and mid caps, they have gone up for sure in the last, especially in the last 3 to 6 months. But they are nowhere near what we would call as a very overheated zone or a bubble zone. We have to be careful at these valuations that we don't invest in weaker businesses or businesses with short-term upsides only. But if you look at from a historical perspective, the valuations are definitely not cheap, but I won't call them as completely overheated or in the bubble zone. So therefore, it's a market to it's a very stock specific market, whether it's large cap, mid cap, or small cap. I think in the near term, large caps probably might be looking slightly more reasonably priced than mid and small caps. But within mid and small caps, also the bottom up opportunities or the stock specific opportunities is what we are focusing on. Instead of looking at it from a large cap versus mid cap versus small cap, I think the focus for us has been more on the stock specific bottom up investing.
So, what will you advise if one asks where to invest currently? According to you, what is the best asset allocation at this point of time?
Well, I think given that the valuations are not cheap, definitely, I would advise a more spread out investment portfolio in the sense that while I remain bullish on certain part of the economy and therefore the broader markets, one should also recognize that the valuations being where they are, there are global risks which can derail the story, which can derail the India investment outlook. And therefore, my approach today is more of a 40-40-20 approach, which means 40% in the hybrid funds, mainly the balanced advantage fund or the multi-asset funds, which can protect the investor volatility as well as give them an opportunity to take advantage of any correction if it happens because of the global risks. The next 40% can be comprising the diversified equity funds. Most prominently, there would be large and mid cap, multi cap, or even value funds, because we think that with the interest rates remaining higher for longer, value as a theme or GARP as a theme will remain relevant for stable future. And the last segment, which is the 20%, should be for higher risk funds where the sectors we like, whether it is banking, infrastructure, or the small cap segment, we play the manufacturing revival. I think those are the two, three, I would say, thematic funds, thematic categories that we would like investors to be present.
You spoke about global risk, but according to you, what are some of the key risks that are on the horizon and which you are seeing right now?
I think the key risk is clearly the geopolitical situation which is there currently in the Middle East, and whether that gets controlled or if it does not get controlled and spreads beyond the current geography, then what does it do to the crude prices? Because India remains completely vulnerable to what happens to the crude prices in terms of both its fiscal deficit, current account deficit, input prices, inflation, the profit growth. I mentioned about 15-16% profit growth for the Nifty 50 earnings that could come under risk. So a lot of issues can go wrong. And that's the biggest risk I would see from an Indian equity market perspective at the current moment.
You also spoke about the thematic funds. So, if we dwell on the banking sector, the mood has turned cautious because of the pressure on the net interest margin from higher deposit rates. So, how do you look at the banking sector currently? Is it the right time to invest in banking funds?
So you're right, there is going to be a little bit of a pressure, but remember that growth has picked up. And today, an average bank is growing at a rate of 15-20%. A below average bank is also growing their book at 10-12%. So clearly, that is being offset. Any NIM pressure will get partially offset by the growth and the operating leverage which the bank will get. We don't see also too much stress building up, barring the extreme low ticket size lending which is happening on the unsecured side. We don't see any stress building on the NPL sides. We don't think credit cost will surprise negatively. And lastly, I think if you look at some of the banking sector or the large cap banks, they are still trading either at the 10-year average or below 10-year average. So if I compare it with other sectors, I still see valuations being reasonable. There is obviously over ownership in this sector. Not every fund or every FII has banking sector, so it might take more time to perform. But if you take a 2-3 year view from here, this is one sector which can give you excellent compounding returns from the current valuations.
Right. Also, want to know your views on passive investing. We know how popular it is outside, but given its low cost structure and the ability to mirror benchmark returns, do you think passive funds going forward can become as popular as they're outside in India?
If you compare it from a relative sense, it should and it will take longer in India. The reason being that India is a much faster growing economy and it's a less mature market. So therefore, when the economy is going through a sustained 5, 6, 7% economic growth for the next few years, there are much more opportunities for an active fund to outperform a passive fund. And this is precisely what has happened in the last, I would say, 18 to 24 months. That post the 2018-19 period when it was tough to outperform the indices. If you look at the 2021-22 period and 23, you would be surprised to see the amount of outperformance which some of our funds and even our peer funds have been able to manage or create over the indices or over the passive funds. So, to my mind, if you look at it on a 5 to 10 year view, I think the outperformance is still pretty healthy. You will always get those periods of 1 year, 2 year, 2 year blocks where one category will look much better than the other. And which is why I think if you look at last 2 years, active funds have outperformed passive funds on an average and by a huge margin. So I think this debate, while passive funds will continue to grow, I think the debate also cannot be very one-sided, and therefore I feel that given the stage of the economy and given the state of the economy in terms of how the growth is panning out in terms of different categories of or different sectors doing well, the opportunities for active funds to outperform will be there over the next 3 years.
Right. Also, one last question before we wrap up the show. What is your view on IT funds? Should one invest in IT funds because they are available at good valuation right now? So, what are your views on it?
It's a stable sector. I think there are still some question marks, some distance to be covered before we can really call a bottom in terms of the fundamentals of the sector. Obviously, stocks might bottom before the fundamentals bottom. Our own sense is that there is still a lot of flux in terms of decision making and postponements of the existing. So even though the companies are getting new orders, the older orders are not getting executed or getting cancelled. So there is a little bit of a flux where the sector is currently, which could continue for another 6 months if interest rates remain high and US growth compound further. That flux could continue for another 12 months maybe. So therefore, we are waiting on the sidelines. We are generally underweight on the sector. I think it's a stable sector from a 3 year perspective. At the current valuation, where I think large caps are looking slightly more attractive than mid cap, and you could have mid cap IT growth also converging towards lower number next year. So all in all, we need to we need to get into this sector slightly more gradually and not very aggressive.
Right. With this, we wrap up the show. Thank you, Mr. Sinha, for your time and for giving us detailed insights on markets and the themes and strategies to watch out for in future. Thank you once again for being on the show.
Thank you very much.
If you like the video, do like, comment, share and subscribe.